Good afternoon and welcome to today's webinar. My name is Jason Kennywell. I'm an investment director here at VentureCrowd. Thank you all for joining us. Today we'll be talking you through our newest private credit opportunity, which is the Gold Coast Secured Credit Fund. We'll provide you a secured mezzanine loan to a luxury residential development located in one of the highest performance real estate markets in the country on the Gold Coast. For those of you who don't know, VentureCrowd is a digital investment platform for private market assets, specialising in venture capital, property, private credit and managed funds. Today we'll be discussing a private credit fund offering investors the opportunity to participate in a mezzanine loan secured by a second mortgage over residential property. Today we'll go through a Cumulus Grand Villas project, including construction and sales progress and the project timeline. Then we'll go through the investment opportunity itself, the fund structure, how your investment is secured, the repayment waterfall and the downside protection. And then we'll have time at the end for a short Q&A before closing the webinar off in about 30 minutes. If you do have any questions during the presentation, please submit them via the Q&A bubble at the bottom of your Zoom screen, and we'll have time at the end to go through those. I am also recording today's session, so if you do have to jump off early, or if you'd like to send it to someone who might be interested in the project, a recording will actually be sent to you. Today's webinar will be delivered by VentureCrowd's CEO, Stephen Maarbani, who will explain the investment opportunity and fund details. As you may already know, Steve is a corporate lawyer and former PwC partner specialising in funds management and is responsible for the legal, compliance and asset management aspects of VC's fund investments. And I also have VentureCrowd Head of Property, David Whitting, who will go through the project. David is a senior development executive with over 30 years experience industry, including as Director of Development for Multiplex, Project Director for Lang O'Rourke, and State Development Director for Grocon. He's been responsible for delivery of over 3 billion, that's 3B with a big capital B, of developments for the companies he has worked for and has operated across commercial, retail, alternative assets and residential. David oversees the property business for VentureCrowd. With that, I'll hand over to you, Dave.
Thanks, Jason. I'm not sure the slides are working. It's gone back to the original one. Okay, there's the profile views. If we just go to the next one, Jason. Okay, that's the cover. It's gone back to the first one for some reason.
Was it?
Yep, now we're on the cover slide. Thanks again, Jason, and welcome everybody. In our presentation today, I'm going to give you an overview of Cumulus on the Gold Coast, as well as some information on the local market, the current state of the project as the first stage looks to complete at the end of the year. And we'll start by showing you a video of the development while I talk over it. Cumulus is our 59 townhome product on the Gold Coast with extensive views over the Broadbeach skyline, which is only 15 minutes away by car. The area of development is just under 4 hectares of our 27 hectare site. The remainder is being regenerated and gifted back to council. It has walking paths laid out for our residents to exercise, walk their pets, or even just to birdwatch. Cumulus has a common recreational facility with seating, barbecues, and a 20-metre wet edge pool with views over the wetlands and the Gold Coast skyline. The houses themselves are 3 and 4 bedroom double story with expansive views over the never to be developed biodiversity habitat. A number of the 4 bedroom houses have 2 master bedrooms, 1 up, 1 down, allowing for separated disability or intergenerational living, or as I sometimes experience, snoring partners. Our prices range between $1.5 to just over $2 million. Our per square metre revenues average around $7,200 per metre. I should point out that rate is under half that of a new non-beachfront apartment and about a quarter of an equivalently sized beachfront apartment and those are hitting now over $30,000 a square metre. We've used best of breed consultants for the project, including BDA architects, known for their premium design in housing and apartment towers on the Gold Coast. And our builder, who is DevCon, are highly experienced house and townhouse builders in the southeast Queensland region with vast recent experience in projects very much like Cumulus. The project itself is fully debt funded through to completion with our debt partners JVL, who are the funding arm of the Van Lieshout family of Super Amart. Another of their divisions are Unison Projects, who are developers of this very kind of product in both Brisbane and the Gold Coast. So they know and understand our product, and this gave them the confidence to invest over $50 million in the debt tranche. In terms of progress on site, civil construction is now complete with all roads and services in place. Our builder DevCon is on site delivering the first stage of 23 houses plus the recreation centre. As at early March, a number of the houses are framed to the first level and some to the second level, as you can see by the videos and recent photos. So those photos that you can see were just taken about 2 weeks ago. So given our debt funding was not conditioned on pre-sales, we have drip fed our product into the market. We already have a third of the first stage under contract, including one that just came in yesterday. The first stage is divided into 4 subsets of the product: Skyline, Canopy, Savannah and Broadview, each according to their slightly varied views, showing product differentiation, which is way over the usual market of townhomes with views that usually look across to each other across an internal road. A few of our homes have small exclusive use areas, allowing small pools or play areas. Importantly, in this market, the whole community is gated, providing peace of mind in a more security-conscious world. As you'll see from the next slide from Michael Matusik, on the revenue side, our pricing from current sales is on track with projections you see in the IM, which shows over $15 million profit after debt. We are confident of exceeding that forecast by the end of the project, given inflation, the constrained competitor supply, as you see from the Michael Matusik slide. The Gold Coast is one of the highest growing but most chronically undersupplied markets for housing in Australia. We're confident in pushing prices beyond our current forecast, given our very recent experience with our projects at Glenvale, where we successfully pushed prices by over 30% in 18 months, and at our Albany Creek project, where we obtained rises of over $150,000 per 3-bed townhouse in an even shorter time frame. On the cost side, I should add that given our fixed price contract with DevCon, we are somewhat immune from the current Middle East-related shocks to build prices, which will instead serve to throttle competitor stock about to enter the market. In relation to the project program, the first stage of the project is on track and due for settlements commencing late this year. Stage 2 and 3 early works are already under early construction, with Stage 2 settlements targeted to commence in August 2027 and Stage 3 in December 2027, with distributions to investors immediately thereafter. As a reminder, we do have a sales office on site, and we would certainly be proud and happy to arrange an appointment for any of you to view the project if you're up the Gold Coast way. Thank you all, and back over to you, Steve.
Thanks, David. That's very exciting. Before I sort of get into the fund details, I just want to point out that these kinds of private credit investment opportunities, such as this private credit fund, sorry, excuse me for 1 second. Apologies for that. I have absolutely no idea where that music was coming from. As I was saying, so these kinds of private credit opportunities were once only available to very large family offices and institutional investors who were investing minimums of $250,000 or more. But over the last few years, mainstream demand for these kinds of quality private credit opportunities has continued to grow. And so for VentureCrowd, our focus has been on democratizing access through our digital investment platform and opening up quality private investment opportunities to as many people as we can with a relatively low investment threshold. This specific opportunity is an opportunity for wholesale investors who are looking to diversify their investment portfolio by adding to it a high yield secured private credit investment opportunity, but without the typical high minimum investment hurdles that historically were attached to these kinds of deals. So let me talk you through the details of the fund now. As David mentioned earlier, this project is well underway from a construction perspective and from a sales perspective. It's not a piece of dirt that's subject to significant risk. It is relatively de-risked in a number of initial ways. It is currently forecast to complete late next year, with final sales expected to settle and investor funds returned by December of next year. So let's say just over 18 months from now. The equity funding for this project closed in under a month. I am personally an investor myself through my SMSF into the equity fund. And as David mentioned, the first mortgage construction funding is now in place, securing construction through to the end of the project. What we're doing today is opening the final tranche of funding for the project, which is a mezzanine debt component through the Gold Coast Secured Credit Fund. Now, this fund is structured as a unit trust, the trustee of which is VentureCrowd nominees, with units in the trust to be offered under VentureCrowd's Australian Financial Services Licence to wholesale investors only. Investors in the fund will participate in a mezzanine loan that is secured by a second mortgage over the property, ranking second only to the first mortgage loan facility on the following terms. You can see them up there, but let me talk you through them on the left-hand side. Firstly, the raise amount is up to $7.7 million. The funds will be invested for a forecast term of about 18 months, which is when the project is expected to complete and final sales scheduled to take place in December of next year. Investors can participate in this fund for as little as $10,000. And this relatively low minimum is very intentional and designed to increase access and to help people to diversify their investment portfolios without having to commit the hundreds of thousands of dollars typically associated with private credit opportunities of this kind. Having said that, our average investment amount is currently $45,000, and we do have a number of investors in this fund who have committed in excess of $250,000. The target interest rate for this fund is 20% per annum, and that will be paid on maturity in 18 months. This rate is very much within the current market range for mezzanine construction finance, which is typically around the 18% plus establishment and line fees range. Importantly, this fund, the loan will be secured by a second registered mortgage at a loan to value ratio, which is just under 65%. Now, the loan to value ratio is calculated based on the peak debt amount, which includes the first mortgage amount and this second mortgage, and is divided by the forecast net revenue. For further details about that and how it's been calculated, the information memorandum contains a feasibility and funding table which describes that in a little bit more detail, and that's obviously available to anybody that's interested in participating. Finally, and I think probably one of the most important aspects here, is built into the project is downside protection of about $15.7 million, which is a fairly significant buffer for investors in this fund. Let me talk you through the repayment waterfall on the right-hand side, and I'll explain how that downside protection assists investors in this fund. So once all dwellings have been sold, and assuming forecast gross sales revenues of $105.5 million holds, which we expect it will, the repayment waterfall will be as follows. Sales proceeds will be used first to repay the senior lender in full. And then this fund will be repaid, principal and interest in full, second in line. Based on current forecasts, that would leave project profit or downside protection of about $15.7 million, which would otherwise be distributed to investors if these forecasts hold. Obviously, this is subject to the ultimate prices that can be achieved for the dwelling sales, but based on the first stage of sales, not only do we expect that those prices will be achievable, but we expect that the continued increase in growth in Gold Coast property prices over the next 12 to 18 months and during the construction phase of this project means that it is possible that that gross revenue number can be improved over the next 12 months or so. Obviously, the usual risks associated with property development projects will always be there, but noting David's update on progress and the number of risks that have already been put behind us on this project, investors should still read the information memorandum in full before making a decision to invest. Now, just finally, before we move to questions, in terms of the process for raising the fund, we will be prioritising allocations based on the date of your registration. So for those who would like more information and have not yet registered your interest, Jason's just brought up a poll which you can use to let us know what it is that you need or your level of interest or what information you'd like. And one of our team members will be in contact with you tomorrow or the day after to discuss the opportunity. Finally, can I just say that I was with David and the sales team on site a few weeks ago, and this is truly a very special project up on a ridge with unobstructed views out to the Surfers Paradise skyline and Broadbeach, 8 kilometres from the ocean. But somehow it feels like it's in the middle of the hinterland because of all of the nature reserve that sits around the built form. Very, very special, very, very beautiful, very different to anything else that exists on the Gold Coast. I am personally an investor in the equity fund, as I mentioned. I'm a big believer of not just this project, but also its location, with the Gold Coast property market continuing to show signs of pretty solid growth well into the next few years. So that's our presentation. And now I think, Jace, we have some time for some questions.
Yeah, thank you. Thank you, Steve, and for all those that have attended. Now is a good time. If you do have any questions, please drop them in the Q&A little bubble at the bottom there, and we'll go through those now. So we've got a bit of time up our sleeves. Okay. I've got a question from Marcus. Steve, what proportion of costs are exposed to variation between now and completion? Is the target return post-fee, post-leverage?
Well, I'll take the last bit. I might throw to Dave on exposure to cost increases, but target return is post-fee and post-leverage, yes. It is forecast to be the net return to investors on completion of the project.
Hopefully you can hear me now. There was a bit of a glitch trying to get myself off mute. I wouldn't be able to give a percentage of costs which are exposed to variation, but what I can say is that we have a fixed price contract with DevCon. There's the usual things in relation to weather delay, but we've not experienced any significant weather delays to date. And given that the forecasts have been better, in southeast Queensland than over the past few years, we're not, and we're coming into winter, we're not anticipating any serious delays from weather-related events in the program to the end of the first stage. If more specific information is required in relation to those costs, we're happy to provide those offline.
Thank you, Dave. Currently, we don't have any further questions. So
Dave, can I just jump in for a sec, Jace, while attendees are considering their questions? One of the things that was particularly important to me from the fund management perspective is this project is now 12 or so months into its sort of original plan. All civil construction works are now very much completed. The infrastructure of the project is now very solid. We're well in construction stage. The next major risk from a fund perspective is always, will these things sell, and will they sell at the kinds of prices that are originally forecast, in the planning stages of a project like this? Dave, do you just want to comment on how sales have gone, and in fact, what that suggests for future sales on this site, given how the numbers
Yeah,
are?
sure. Thanks, Steve. I did talk a little bit about it in my presentation. Sales are going according to plan. We have throttled them back a little bit because we see a lot of growth coming through in the market, particularly occasioned by the constraints on supply with our competitor product, which has probably even got worse for them over the past few weeks with what's been happening in the Middle East. Individual prices vary, but in terms of the 9 that have been sold, they are around budget for the 9 that we had. What usually happens is, in a project such as this, you start to sell the first few ones a little bit below budget. Around the middle of the project, you hit around budget, and then you start to go over budget in terms of those price points as you go through the project. As I did say, that's exactly what we experienced at both Glenvale, which is still going. Our last, few stages will probably continue to demonstrate that kind of price movement. Also happened at Albany Creeks, where over 18 months we were able to raise prices $150,000 for a 3-bed townhome. And those townhomes were not nearly as nice as these ones at Carrara. So we kind of expect no different in relation to the kind of growth that we would hope to experience with this product. It is more premium. It is less subject to the vagaries of interest rate movements because most of our buyers are downsizers that are cash buyers. What usually happens with products such as these is, as the project gets very close to completion, there starts to be a run on sales because people often have to sell their own houses to downsize. They're not just coming in from another market as cash buyers. At that time, of course, there's always a certain number of people selling houses and moving. The amount of stock that's available for them as options on the Gold Coast is really very, very limited, particularly in the new home market, which obviously this is. So, all of those factors together, give us quite a deal of confidence in relation to pricing.
And David, just to add to that really quickly on this issue of sales risks, because frankly, the final risk in this project for investors in the fund is going to be construction risk and sales risk, right? You've already talked about DevCon, fixed contract pricing, and all of those risk mitigation strategies with the builder. No one can control weather, but we note what you say about moving into winter is obviously important. Then on sales risk, you've covered a lot of it. But the other thing I think is worth listeners being aware of is that JVL, who's the first mortgage construction financier, who would typically be very conservative on a project like this, has imposed no pre-sale conditions. And that tells me a lot, because what that suggests is their faith in both the project, the product, its pricing, and its location are such that they don't need the comfort of pre-sales. And in fact, when a first mortgage construction financier of that caliber decides not to require pre-sales, it says a lot about the potential for gross revenue to increase over time. And it allows the developer, and David mentioned this earlier, but just to reinforce his point, to hold back on sales initially in order to maximize revenue for the project at the end. And all of that is good news for the funding partners, including this fund.
Excellent. Thank you, guys. There is another question, which I think you've pretty much probably just covered it, but I'll read it out just in case you want to add anything. What's the current sales velocity achieved relative to the go-forward assumption and pricing assumption? Is there anything you want to add to that? Dave
Um,
or Steve?
not apart from, I think I did answer it generally. As I said, we've got through a third of the first stage in terms of sales. In fact, probably a bit more than that. So we've got 9 of the 23 away in the first stage. We do want to hold back now a little bit to be able to obtain, price rises which are even greater than we've forecast. But certainly, as I said, the prices for the 9 that we've sold are at or about our forecast revenues.
Yeah, thank you, Dave. I've just left the poll running there, so just in case there's a few people that haven't answered, but that's okay. But I'll leave it running for another couple of minutes. If you do want to answer that, it should be a pop up on your screen there. And we've got a little bit of time left. If there's any further questions, please feel free to pop them in. As Steve mentioned earlier, our team will reach out over the course of the next couple of days for you, and we will email you a copy of the recording of this webinar, and can obviously provide the information memorandum and link to the deal page so that you can read everything you need to read. It looks like we don't have any further questions, so I guess we can finish a couple of minutes early. Thank you, everybody. Oh, hold on, just in time. We have another one. Just to further clarify, based on what you have achieved so far in terms of cost commitments and sales, volume and price, there is no valuation impact as the project comes towards a completion. Discount rates. Example discount rates. Valuation impact.
If I think I can get to what the questioner is asking, there should be no valuation impact because we are achieving prices at or about what we're forecasting in this IM. As I said, we do hope to go beyond those, but we've been conservative for this. And I reiterate again, there's over $15 million worth of profit, which is at risk first before this facility as well. So, there's some conservatism, there's upside, and there's buffer in terms of the risk on this facility.
Yeah, thank you, Dave. Yeah, I think that's covered it. And I think I'm assuming discount rates is like you don't envisage certainly doing any discounts on the project. And what we've seen in the past is when you build something like that recreation centre, which having been on the site 2 weeks ago, is looking awesome.
Well, the question may be asking about discount rates on pricing. We occasionally might do very minor things, a white goods package. Usually most of any upgrades that are requested of us where it's costed through and given to the purchaser. Depending on various things, we may do a sales campaign to try and move some stock in some circumstances before a particular date or something or other. We're not envisaging many of those kinds of things for the project. But occasionally, as I said, you may give a very minor discount to get somebody over the line in terms of a sale. And as traditionally, I think on this project, it's been like a dishwasher and a dryer kind of thing or something like that.
Yeah.
So, yeah.
Perfect. Okay, that looks like we've right on time reached the end there. Thank you very much to everybody for joining. Thanks, Dave and Steve, for your input. Appreciate it.
Thanks all.
I'll end the webinar there. Thank you all.
Thanks, everybody.
Thank you.
Good day.